The silver market is sending a signal so loud, so urgent, it's the kind you only see once in a generation. And yet, almost nobody seems to grasp just how close this entire system is to completely cracking. What we're witnessing right now isn't just another rally or a market cycle or some temporary trading setup. This is a structural break, a deep fracture in the physical supply chain that the paper market is struggling to hide. Consider this. In just the last 47 days, a staggering 37.6 million ounces of silver have vanished from the Comex vaults. And no, this isn't your average retail buying spree, and it wasn't consumed by industry. This silver has left the system entirely. It's been removed, shipped out, or reclassified by major players who clearly no longer trust the futures market to deliver. This is the largest, most aggressive drain on silver inventories since 1980, the year silver skyrocketed to nearly $50 an ounce and almost brought down the Comex itself. But what's happening today is even more alarming, because unlike 1980, the world now consumes more silver than it produces every single year. A persistent structural deficit. If you're watching this, drop your thoughts in the comments and make sure you stick around, because the opportunity I'm about to reveal is closing much faster than anyone could have imagined. To understand why a future with $100 silver is not just possible, but probable, and why major banks are quietly restricting the sale of physical silver, you need to grasp one critical concept. The paper market is losing its grip on reality. For the first time in over a decade, the price for immediate delivery of silver, the spot price, is trading higher than the price for future delivery. This condition is called backwardation, and in the world of commodities, it's a 5-alarm fire. Backwardation is a scream for help from the market. It means that buyers are no longer willing to trust a promise for future delivery. They want the metal in their hands right now. Oil went into backwardation just before its massive spike in 2008. Wheat did the same right before the food crisis of 2010. Palladium showed the exact same signal just before it exploded to over $2,700 an ounce. Every single time this happens, it points to one terrifying truth. The real physical supply is gone. Right now, the amount of silver available for delivery on the Comex has collapsed from 80 million ounces to just 43 million, and that number is shrinking by the day. Think about that. The entire global price for a $1.5 trillion industry is being dictated by a warehouse that holds less silver than a single large solar panel manufacturer uses in a year. And this brings us to the most dangerous part of this entire setup. For every single physical ounce of silver that actually exists in a vault somewhere, there are anywhere from 50 to 100 paper claims on it. ETFs, futures contracts, unallocated accounts, complex bank IOUs, all representing silver that simply does not exist. For decades, this massive leverage worked because most people were content trading digital numbers. They never asked for the real thing, but that's changing. Once investors, industrial buyers, and even entire nations start demanding actual silver bars, the whole fragile system gets exposed for the illusion it is. Sure, the Comex can settle contracts in cash, but you can't build a solar panel with cash. Car makers can't solder microchips in an EV with paper silver. When the physical metal runs out, the game is over, and that is exactly where we are heading. The drain on physical inventory is accelerating because the big players, nations, and institutions are no longer selling their physical silver, even as the spot price rises. They're holding on to it. Why? They see what's coming. Major banks have quietly changed their policies, preventing outbound shipments of silver bars, except to their most long-standing industrial clients. Some sovereign mints have started rationing their output. And several nations, including some with large mining sectors, have simply stopped exporting their refined silver. They're keeping it. They're hoarding it, because they see the deficit unfolding in real time. In 2024 alone, the silver market is projected to run a 149 million ounce deficit. This is the third straight year of these deep structural shortages. Mining supply is flatlining. Recycling efforts are stagnant. Meanwhile, the fastest growing industrial sector in the world, solar energy, is now consuming over 200 million ounces of silver per year. That's more than half of the entire global mining production. Here's the truth that many in finance refuse to acknowledge. Silver is not just a precious metal anymore. It is the irreplaceable backbone of our modern technological world. It's the most electrically conductive metal on Earth. Every smartphone you own contains it. Every electric vehicle uses between 1 and 2 ounces. Every 5G tower, every data center, every missile guidance system, every medical imaging machine, they all rely on silver. And unlike gold, which is mostly hoarded, silver gets consumed. Once it's used in a tiny electronic component, it's usually gone forever, too costly to recover. Scrap supply is drying up, and finding high-purity, industrial-grade silver is getting harder each month. The system is simply running out of the one metal that keeps the entire electrical age alive. Now, let's look at how these situations typically unfold. Every paper market collapse in history follows a classic 4-stage pattern. Stage 1 is complacency. Inventories start to decline slowly. Most analysts dismiss it, blaming seasonal factors or investment rotation. Silver went through this stage from 2017 to 2020 as vaults quietly emptied. Stage 2 is the structural deficit. Industrial demand finally overtakes supply. The solar industry explodes. EV adoption accelerates. But the mines can't keep up. This happened from 2020 to 2023. The deficits grew larger and larger in the background, yet the price mysteriously went nowhere, even as inventories were being drained. Stage 3 is recognition. This is where we are right now. Backwardation appears. Premiums for physical metals soar. The drain from vaults accelerates. Nations start hoarding and banks restrict physical sales. This is the moment the market finally realizes the math doesn't add up and can't be fixed. That leads to stage 4, panic and price dislocation. The paper market finally breaks. The futures price detaches completely from the physical price. Retail shelves are empty. Industrial users panic and start outbidding investment buyers, desperate for supply at any price. In this stage, prices don't just rise by $5 or $10. They gap up violently, hitting levels that seemed impossible just months before, until they become the new normal. Every major commodity crisis has followed this exact pattern. Oil did it, wheat did it, palladium did it, and today silver is walking the very same path, but under conditions that are far more extreme. Unlike oil, we don't have strategic silver reserves to tap into. Unlike wheat, you can't just plant more silver and wait for the next harvest. And unlike palladium, there are no large-scale cost-effective substitutions for silver in its most critical applications. The world simply needs more than it can produce. To understand how dangerous this setup is, just look back at 1980. Silver hit 49 an ounce when the Hunt brothers attempted to corner the market. But even during that mania, Comex inventories weren't collapsing like they are today. Industrial demand back then was a tiny fraction of what our solar and EV sectors need now, and yet the system still nearly failed. Today's conditions are the same, but magnified by a factor of 10. More demand, less supply. More paper leverage, less physical metal, less trust in the system. The people buying up physical silver today are not just speculators. They are industrial giants, sovereign entities, and financial institutions with inside visibility into the supply chain. They know the paper market is a house of cards. They know the leverage is unsustainable, and they know that if they want to have metal in 2025, they need to secure it right now, while they still can. Because once stage 4 hits, there will be no more price discovery. There will simply be no supply available at any reasonable price. And the moment the broader market realizes that, the window to acquire physical silver for under $100 an ounce will slam shut permanently. The big question about the silver market isn't if it's going to break anymore. The question is when, and more importantly, who's going to be on the wrong side of that break. Here's a hard truth that most people don't want to hear. If you think you own silver through a paper contract or an ETF, you probably don't. You own a synthetic claim on silver, and in a real crisis, those synthetic claims get settled in cash, not physical metal. The entire system is built to protect the exchanges, not you, the investor. History shows us this pattern over and over again. Think back to the palladium crisis in the early 2000s. Automakers like Ford ended up with billions in paper losses, all while scrambling desperately to find the actual physical metal they needed for production. Or look at the silver crisis of 1979 to 1980. The exchanges changed margin requirements and position limits, crushing anyone holding paper contracts, while the price of physical silver shot to the moon. In every single commodity crisis, it's the paper holders who get wiped out first. Right now, the biggest warning sign is the growing gap between the price of physical silver and the price you see on the Comex exchange. Industrial users, the people who actually need the metal, are quietly paying 20 to 30% above the spot price just to guarantee they get their delivery. Wholesale suppliers are telling clients to expect delays of 8 to 12 weeks. Several national mints aren't selling freely anymore. They're on an allocation basis, meaning they're rationing what little supply they have. This is a classic sign of backwardation. It's the market screaming, "I don't trust that you can deliver the metal later." And when delivery is in doubt, the only thing that matters is the physical commodity itself, not some digital number on a screen. The supply situation is even more dire than most people realize. There's this old idea that silver is abundant. Geologically, maybe, but economically, it's a completely different story. About 70% of all the silver mined in the world is a byproduct. It comes from mining other metals like copper, lead, and zinc. This means silver producers can't just decide to mine more silver when the price goes up. Their output is completely tied to the demand for other metals. If copper demand flatlines or a few major zinc mines shut down, the world's silver supply drops, no matter how high the silver price gets. It has the most rigid and flexible supply chain of any major industrial metal. Meanwhile, the demand side is exploding. The solar industry is now consuming more silver than any other sector in history. Solar panels require a high-purity silver paste, and every attempt to use less or find a substitute has failed or resulted in performance losses that manufacturers can't afford. With the world expected to add over a terawatt of new solar capacity every year, the demand for silver from solar alone could top 250 million ounces a year by 2026. Now, add on the demand from electric vehicles, all our electronics, medical applications, military tech, and the new wave of AI-driven data centers. What you have is a massive wall of demand about to smash into a supply chain that's already shrinking. This isn't a temporary problem, it's a permanent deficit. The Silver Institute has been tracking this for years, documenting massive structural shortages totaling hundreds of millions of ounces. How has the price stayed so stable? Because we've been draining the world's above-ground stockpiles to fill the gap. But those stockpiles aren't infinite, and they are now hitting critically low levels. Once they're gone, the physical shortage will be impossible to ignore. That's the moment of price dislocation. The futures market will keep flashing a number on the screen, but it won't matter. No one who needs real physical silver will be able to get it at that price. The price for actual silver bars could be several times higher than what you see on TV. We're already seeing hints of this in the wholesale markets today. On top of all this, you have a major geopolitical shift. Nations around the world are losing trust in Western paper markets. Countries are quietly adding physical silver to their strategic reserves. Exchanges in Asia are seeing huge volumes of physical turnover, while vaults in the West are being drained. The flow of silver is moving from west to east, and historically, once metal goes east, it doesn't come back for decades. This is the exact same pattern we saw with gold in the early 2000s, right before it began a 10-year bull market. Silver is on the same path, but the conditions today are far more extreme. Even regulators are getting nervous. Many large banks have been hit with restrictions on shipping silver out of the country because regulators know how thin the supply chain is. These banks are now prioritizing their long-term industrial clients, which means retail buyers are getting a smaller and smaller piece of the pie. In some places, banks have been flat-out banned from selling physical silver to the public to prevent a panic. These aren't just rumors, these are official policies. They are clear warnings from authorities that the system is under incredible strain. There's a 4-stage pattern that plays out in these situations, and we are getting dangerously close to the end. We're currently in stage 3, recognition. This is where you see the backwardation, the vault drains, the delivery delays, and the hoarding. But stage 4 is panic. That's when the paper system finally snaps. It's the moment when the price on your screen is no longer the real price because there is no metal available for that price. It's when industrial users start bidding directly against investors, when wholesalers just stop selling, and when government mints go dark. It's when the premiums on physical metal explode so quickly that the spot price becomes a meaningless fantasy. If you want a preview of Stage 4, just look at what happened to palladium in 2019. This all leads to one final, inescapable truth. In the end, physical silver always wins, and paper always loses. Why? Because paper is infinite. Silver is not. You can print an endless number of futures contracts. You can create more and more ETF shares. You can pile on leverage. But you cannot print a silver bar. You cannot create physical ounces out of thin air. And when the market finally demands a reckoning, the entire synthetic side of the market will evaporate. Cash settlement will be the only escape hatch. The people holding claims will walk away with excuses. The people holding the real metal will walk away with the value. Silver isn't just a precious metal or another investment. It is a critical, strategic industrial resource that the modern world is consuming at a rate that the mining industry simply cannot sustain. Once we hit stage 4, the question won't be, what's the price of silver? The question will be, can you find any at all? A $100 price for silver isn't just a wild forecast. It's a structural inevitability once the paper market loses control. And right now, all the fracture lines are getting wider. Thanks for watching.